Next is installment acquisition. Now, the cost is the cash price equivalent. So that is still the cash price equivalent. The excess of the installment price over the cash price is treated as an interest to be amortized over the credit period. If there is no available cash price, the asset is recorded at an amount equal to the present value of all payments using an implied interest rate. Alright, so class, if you notice that if you are to acquire an appliances or if you're to acquire a TV using in an installment method, you can the seller gives you or the seller shows you two prices, the cash price and the installment price. Now in accounting for installment acquisition of PPE, although we are to acquire it using the installment acquisition or the installment method, we still have to record our property, plant, and equipment in its cash price equivalent. So, the difference between the cash price equivalent and the installment price is to be treated as an interest. Okay, that is to be treated as an interest. Now, let us discuss illustration 3. Credulous Company purchased equipment on January 1, 2019 under the following terms. First, a 200,000 down payment and 5 annual payments of 100,000. The first installment note to be paid on December 31, 2019. The same equipment is available at a cash price of 580,000. So as you can see, we have two here. Installment price and the cash price. Plus, if you're going to add all that you're going to pay, so you have 200,000 down payment and 5 annual payments of 100. So this is 100,000 times 5, that is 500,000 plus the down payment of 200,000. So that is 700,000 pesos. So that is our installment price. While our cash price is only 580,000 pesos. So what are we going to choose as the basis of our initial measurement is, of course, that is the 580,000 cash price equivalent. Now, how do we journalize? Illustration 3. So that would be a debit to equipment. So using the cash price equivalent of 500,000. Credit to notes payable. So, since we are to pay 5 annual payments of 100,000, so that is 100,000 times 5, so we get 500,000. And our down payment, so that is our cash, that is 200,000. So, what did I just mention is the difference between our installment price and the cash price equivalent will be treated as an interest. But for now, we have to record it still at discount on note payable, because such discount on note payable will be amortized as interest over the period of our or over the term of the note payable. So how much is the difference? That is 700,000 minus 580,000. So the discount on note payable is 120,000. Okay, so take note of this one. We are to treat the difference of the installment price and the cash price as a discount on note payable. Okay, so this is the journal entry at the time of acquisition. Now, how about if you are already going to pay? So, let's say it is already December 31, 2019. So, we will have to pay our first installment. So, that would be debit, note payable, and credit to, of course, cash. As stated in the problem, we have to pay 100,000 annual payments. So that is debit 100,000 and credit another 100,000. That's what I have said. The discount on note payable will be amortized as interest expense over the term of the note. So at the end of every year, we also have to record the interest expense and cancel the pertaining discount on note payable. So this is what we call the amortization. So how much is to be amortized during the year 2019? Now in this case, class, we are going to make a table based on how much is the outstanding balance of our note payable. Now we will record the outstanding balance of the note payable in the first year, at the end of this at the beginning of the second year, at the beginning of the third year, at the beginning of the fourth year, and fifth year. Okay. So, how much is the outstanding balance of our note payable? So the outstanding balance of our note payable at the beginning of the first year is the 500,000 because that is our initial measurement of the note payable. After we paid 100,000, so we already have 400,000. Then we have 300,000, 200,000, and then finally in the last year we have 100,000 left. So take note, this is the outstanding balance of the note payable. Now, we are to allocate the interest expense. Now, take note, class, that our discount on note payable was 120,000. So, such discount of 100,000 will be allocated on the 5 different years using the fraction of the outstanding balance of the note payable. So, just like what we did in the acquisition on cash basis, we are going to take the fraction of the outstanding balance. So, for the note payable, if we are going to add this one, that is 500 plus 400 plus 300 plus 200, that is 15. 500 plus 400 plus 300 plus 200 plus 100, that is 1,500,000. So for our fraction in the first year, that is 5 over 15. Okay, that is 5 over 15. Right, 5 over 15. 500,000 over the total of 1,500,000. The second year, that is 4 over 15. Third year, 3 over 15. Fourth year, 2 over 15. And fifth year, 1 over 15. So that is our fraction for the interest expense. Now, how do we compute for the interest expense each year? So that would be 120,000 multiplied by the fraction of 5 over 15. Next, 120,000 multiplied by 4 over 15. Okay, and so on. 120,000 times 3 over 15. So that would be 120 multiplied by fraction of 5 over 15. Okay, 120,000 times 5 over 15, that is 40,000. 120,000 times 4 over 15, that is 32,000. 120,000 times 3 over 15, that is 24,000. And 120,000 times 2 over 15, that is 16,000. And 120,000 times 1 over 15, so that is 8,000. So this is the amount of the interest expense that is to be recognized in the different years. So if you're gonna add this one, if you're gonna add all of this, that is 40 plus 32 plus 24 plus 16 plus 8, so that is 120,000 in total. For the first year, class, we are to we are to amortize the first 40,000. So that would be a debit to interest expense of 40,000 and the discount on note payable of 40,000. So at this moment, the balance of the discount on note payable is now 80,000 pesos. And that includes from the second year to the fifth year. Okay, so that is the installment acquisition. Alright, now next, let's proceed. Okay, so for the illustration 4, this is still installment acquisition, but in this case, there is no available cash price. Class, in the previous example, okay, as you can see here in the previous example, we have available cash price of 580 aside from the 700,000 total that we are to actually pay. Okay, we have a given 580,000 available cash price. Now, how about us if the cash price is not given in the problem? What are we going to do? Are we going to resort to, instead of recording at a cash price, we will already record it at the installment price? The answer is no, because class, the asset is acquired by installment and there is no available cash price, the asset is recorded at an amount equal to present value of all payments using an implied interest. So meaning, instead of the cash price equivalent, we are to use the present value of all payments using an implied interest. How do we do that? Let us answer illustration 4. Alright, so illustration 4. On January 1, 2019, Enrich Company purchased a machine under the following terms. First, 100,000 down payment. Second, 4 annual payments of 200,000. The first installment note to be paid on December 31, 2019. The fair value of the machine is not clearly determinable under date of acquisition. So meaning we cannot determine the cash price equivalent or the fair value of the machinery. But the prevailing rate of interest for this type of obligation is 10%. And the present value factors at 10% for 4 periods are, we have present value of the lump sum, that is 6.83. That is 0.683, and the present value of ordinary annuity of 1, or the installment, that is 3.170. Now, let us first, before we make the journal entry, let us first find the cash price equivalent of the acquisition. Alright, so for the cash price equivalent, or let's say the present value of the payments, the present value of the payments. So we have we are to pay 200,000 per year. Okay, we are to pay 200,000 per year. So what present value are we going to use? So we have two present values that is given. The 0.683, which is the present value of 1. So this is the present value if you are to pay lump sum. And we also have the present value of ordinary annuity of 1, that is 3.170. This is the present value we are to pay every year. Now, since we have to pay 200,000 annually, so we will use the 3.170 present value factor. So the present value of the future payments is 200,000 multiplied by 3.170, that is 634,000 pesos. But apart from that, class, take note that we have a down payment of 100,000. We also have to add this one in order to determine the fair value of our fair value of the machinery. Okay, so we have 634 plus 100,000. Sorry, that is 734,000. Okay, the present value of all payments is 734,000. This one, class, this is present value of the note payable. This one is the cash price that we paid at the time of the acquisition. So that is 100,000 and 634. So that is 734,000. Now to journalize, so just like in the previous example, we have debit to machinery of its cash price equivalent. So that is 734,000. Credit to note payable. So how much is our note payable? So that is 200,000 multiplied by, there are 4 annual payments, so the note payable is 800,000. And aside from the note payable, we also paid cash of 100,000. So how much is our discount on note payable? So if you remember, the discount of note payable is the cash price equivalent versus the installment price. So we have here the installment price is 900,000. The cash price equivalent is 734. So 900 minus 734, that is 166,000. So this will serve as our discount on note payable. Alright, now let us see if our journal entry is balanced. 734 plus 166, that is 900, and 800 plus 100, that is 900,000. Now in this problem, how are we going to journalize the amortization of the expense? So class, at the time of payment, so since we are to pay annually, we are to record it normally. So debit, note payable, and credit cash. So every year, we are gonna pay 200,000 pesos. Okay, now how about for the entry on the amortization? Okay, if you remember, in our illustration 3, the amortization is a debit to interest expense and credit to discount on note payable. So this time, class, we are not going to allocate the discount based on our outstanding balance. Just like what we did here in our previous example, that we computed our amortization using the outstanding balance, because this is a different case, class. There is already a given interest rate, so we have to make an amortization table for the amortization of the interest. So what are the inclusions of the amortization table? So let's start with the year, the payment, the interest, the principal, and the present value. Okay, now let us see if how much is our amortization of the interest expense. Let's start with January 1. So on January 1, so that is still the time of acquisition. So on January 1, the present value is the 634,000. Okay, take note, class, that we only get the 634,000. This 634,000 amount is because this is an amortization of interest, and the interest only pertains to the note. So we will use 634,000. Okay, so for this one, class, let us change this one to fair value of the machinery. Okay, 634,000. On January 1, there is still no payment on the note. There's still no interest, and of course, there's no principal payment. The first payment was on December 31, 2019. So that is our first year. So at the end of the first year, we paid 200,000. 200,000. So in the payment of 200,000, it includes the interest and the principal. Now take note that the present value only contains the principal. When we say present value, there is no interest included in the amount. So therefore, we have to get first the interest portion of the 200,000 before we can get the remaining present value at the end of the first year. How are we going to compute for the interest? So for the interest class, that would be the present value multiplied by 10%. Okay, so present value of 634,000 times 10%. So our interest amortization for the first year is 63,400. Now, 200,000 minus 63,400. So the principal portion there is 136,600. Again, for the 200,000, 63,400 is the interest and 136,600 is the principal. So, for the present value balance, we are only to deduct the principal. Okay? 634 minus 136,600. So, we can get 497,400. Now, how about in the second year? That is the same method. For the second year, we will pay 200,000. For the interest, as what I've said, that is the present value multiplied by 10%. Now, in this problem, the remaining present value is 497,400 multiplied by 10%. So, that is 497,400 times 10%. So, we can get 49,740. And for the principal, that is 200,000 minus the 49,740. So there is a remaining 150,260. Okay, so same method, 497,400 minus 150,260. So the balance is 347,140. Okay, for the third year, still 200,000. Okay, the interest is 347,140 times 10%. We get 34714. For the principal, 200 minus 34714, that is 165,286. For the present value, previous present value minus the principal, so we have 181,854. We still have the fourth year since this is 5 years. Oh, sorry, this is 4 years. So, this is the last one, 200,000. Plus, take note that at this point, our present value should already be 0. It's because this is the last year of the annual payment. So, our present value should already be 0. Now, for our interest, that is 181,854 times times 10%. So we can get 181,854 times 10%. So that is 18185. So if we're going to deduct 18185 minus 200,000, so that is 181,815. So if we're gonna deduct 181,815 from the 181,854, it will not result to 0 class. So, what we're going to do with this one is we have to work it back. Because this have to be 0. So, instead of doing the normal multiplication of the interest by 10% and then deducting the interest from the payment to get the principal, we are going to work it back. So, we will start here with 0. And to make it 0, there should be a deduction of the principal of 181,854. So, therefore, the interest should be 200,000 minus 181,854. So that should be 18146. So why did we work it back? Is because class, if we are going to follow the normal in which we are to multiply 10% and then deduct the interest from the payment and then deduct the principal from the previous present value, we are not gonna get zero because class, during the process, we encountered rounding off the numbers. So there is still a possibility that it will not result to zero. Um, but the thing there is that it is not really zero, that the result is not really zero, but it is very closer to zero. So that's why we just work it back to get the zero. Okay. And then, so this is our amortization table. Now let us check class. Okay, if you remember, our discount on note payable is 166,000. Now let us see if all the interest payments totals 166,000. So that is 63,400 plus 49,740 plus 34,714 plus 18,146. So we get 166,000. So meaning the 166,000 discount on note payable is amortized every year with these amounts. And in our problem, for the first year, the interest expense that is to be recognized is the 63,400. Okay, so this is the amortization at the end of the first year. For the remaining year, we will use the second year interest, the third year interest, and the fourth year interest. If you want, you may also make the journal entries for the rest of the years. Okay, so that is for the installment acquisition. Now, let's proceed to the issuance of share capital. Now, for the issuance of share capital, or where a property is acquired through the issuance of share capital, the property shall be measured at an amount equal to the following in the order of priority. So first,